to our webinar on appraisals, and we've got our special guest with us today. We have Stephen Sousa. Steve is the Executive Vice President and Chief Staff Officer at the Massachusetts Board of Real Estate Appraisers, MBREA. It's a Boston, Massachusetts-based professional association for real estate appraisers founded in 1934. The MBREA is New England's leading provider of education for both the appraisal profession and to meet mandatory continuing education requirements, not so dissimilar from our association. At MBREA, Steve directs the daily operations of the organization and participates on the executive committee and board of trustees. He also serves as the association's lobbyist, both on Beacon Hill and Capitol Hill. Prior to his current position, Steve was Senior Vice President and Associate Publisher at the Warren Group and served as President of both of the state's trade associations for mortgage bankers, lenders, and brokers. A graduate of Boston College, Steve also serves as the Director of the Fields Corner Community Development Corporation and as a Director and Chair of the New England Society of Association Executives, at which I am lucky to serve with him. As a resident of Dorchester, Steve grew up in Weymouth and has 3 adult children and 8 grandchildren ranging in age from 4 to 26. So welcome, Steve.
Thank you very much, Maria.
And we also have with us this morning, Dorianne Alexandropoulos. Dorianne is Vice President of Appraisal Quality Control at Leader Bank NA in Arlington. In her 6th year with Leader Bank, Dorianne manages all aspects of residential appraisal, regulatory compliance operations, policies, and procedures. Dorianne is a graduate of the University of Lowell, a certified residential appraiser, and an MBREA member committed to appraisal industry education and professionalism. And I just want to thank you both for taking the time to spend with us today to answer a lot of questions that our members have been having with appraisals now. So I'm going to kick it over to you both. Thank you.
Okay, well,
thank you, Maria.
Thank you, Maria. And I'll get started with just a few words about the appraisal profession and some of the things that are going on right now. I would imagine that most of your questions are going to come in directed more towards Dory because of both her position and her credentials as an appraiser. So I'm going to be moderating the Q&A as we're going along, and I see we already have our first question up, but we'll get to those questions in just a little bit. Let me tell you just a little bit about the appraisal profession in Massachusetts. Right now, there are 1,920 licensed and certified appraisers in the Commonwealth. That number's gone down quite a bit over the past couple of years as appraisers have retired and moved out of the profession. Of those 1,900 appraisers, only 1,000 of them are certified residential. So that's a pretty small population of appraisers to be working on all of the assignments that are out there. There's another 680 who are certified general, which means that they can do both commercial and residential work. And there's 188 who hold the licensed appraiser category, which allows them to do residential work up to just a certain dollar amount and scope of work. The interesting thing is that of that group of appraisers, the majority are probably look a whole lot more like me in terms of age and demographics. There is not a significant population of younger appraisers in the profession, and that could provide some stress as we go forward in the next several years. Getting into the appraisal profession is difficult. Up until just recently, you needed to become certified, you needed a 4-year college degree. That has been changed. You would also, for certified residential, have to take 200 hours of classroom appraisal specific education. And then you'd have to train under a certified appraiser for 12 to 18 months before you then could sit for the national 4 to 6 hour licensing exam. So it's a pretty rigorous process. It's an expensive process, and it doesn't encourage a lot of people to get into the profession at this point in time. Right now, I think we're finding that most appraisers are probably booked out 2 to 4 weeks, maybe even a little bit longer, because of the volume of business that Dory and all the other lenders in the Commonwealth have. You know, we're in a period of historically low rates. It's driving the refinance market crazy. And we're coupling that, again, with only a limited number of appraisers who are out there to do all the assignments. So it's not surprising to me that we, are looking at longer turnaround time to be able to get the assignments done. And working with the lenders, the appraisers do try to prioritize to some degree the purchase deals, because they realize that there could be timeframes built into, agreements for closing. But there's still, a lot of work out there. The other thing that's going on is that appraisers and lenders, and Dory will talk about this a little bit more, are still grappling with and adapting to the whole COVID-19 and the changes in the guidelines, and when is an appraisal required, that, when the appraiser has to go inside versus doing a desktop or an exterior only, and that those assignments can change midstream sometimes. The other thing that we're dealing with is that a lot of the lenders are trying to beef up their staff, but they're significantly all working remotely. I think easily in most lenders shop right now, at least 90% of the staff are working from home, maybe even more than that. And so as they hire new folks, it makes the training that much more challenging, because they can't have somebody sitting right next to the desk of someone who's more experienced. And so you might run into a situation where you've got somebody who doesn't have quite the depth of experience or the ability to just turn around and say to a supervisor, hey, can you help me out with this one? They've got to do it all remotely going forward. So with that kind of as a backdrop for some of the current conditions, Dory, I'm going to kind of move us through some slides, and
Sure.
more than welcome any of the comments you want to add. I just got to figure out where my little advance button is here. Here we go.
Well, Steve, I think you hit on a great overview of what's happening. So the lending industry, the appraisal industry, the brokerage industry, we're all dealing with COVID-19 impact. We're dealing with all these low interest rates, and in the real estate industry, very limited supply, and yet we have a really high demand for purchase money and for refi money because the rates are so low. So the consumers all want to take some big advantage. But some downsides of that are the fact that the consumer does not have a lot to pick from. And then we've got lots of multiple offering going on, and the audience I would actually love to hear from the audience about what's happening out there in the marketplace. But we're seeing, and I know that you are all seeing, lots of multiple bidding and fueling of bid prices higher and higher and higher. Give me your highest and best, and all of that that's going on. On the appraisal side, the impact for the appraiser and the impact for the lender, I'll explain that a little bit. So we all have had that experience where, maybe we've got an appraisal that isn't supporting that high bid. I want to give you a little background on the regulatory compliance. So the majority of these loans are sold off into federal markets. So these are market players that buy these loans from the lenders. The appraiser has a couple of obligations. So the first, of course, is the appraisal licensing and the appraisal principle, which is called USPAT. And then there is an overlay requirement from these market players who buy these loans, and they require specific content in an appraisal, and they have specific guidelines that appraisers have to follow. So the appraiser is juggling both things, which is the appraisal principle ultimate guide, and the add-on from what all these market players are asking for. And just so you understand, they're asking for these things because they are assessing their risk, and they've set up business models to assess that risk. So they're looking for specific content in the report. So that, just so you know, when an appraiser does perform an appraisal report for this buying audience, and for the majority of the time that's what we're doing, they're federal related transactions, the content requires them to put primary emphasis on closed sales. There can be consideration for sales that are under agreement, active sales, you know, all that kind of analysis comes into play with the appraiser. But from the people buying these loans, they really want the emphasis to be on what's closed, because if you just think back to what I just said, they're assessing their risk. So what is the risk for them? Now we have escalating markets and we have high bidding. And when an appraiser does their analysis and talks about appreciation and multiple bidding, there is a great responsibility on them to make sure the analysis and the extraction of that analysis is supported and it's credible and they have concrete evidence of it in their report. And in this environment of COVID and economic uncertainty, borrower credit uncertainty, when a lender reviews an appraisal, and then when ultimately it goes to whoever's buying it and their review of the appraisal, they're looking at these appreciation and these overbidding scenarios with great caution. There's another part of the dynamic here, and you've probably all heard about this, is obtaining an appraisal waiver. These government entities have an algorithm that they use. So they look at the borrower creditworthiness, they look at collateral creditworthiness, they look at economic data. They have lots of information at their disposal. They follow housing pricing indexes, and they come up with an algorithm that I don't know the detail of, but they decide when they are looking at the application and when they're looking at everything about the buyer and when they're looking at everything about the collateral and the appraisal, that they decide, you know, I'm sorry, not the appraisal. They're looking at probably the purchase contract and the purchase price. They make the decision that they're comfortable enough with the risk to not go forward with an appraisal. And I'll explain a little bit more why. So these agencies, especially Fannie Mae and Freddie Mac, they collect all these appraisal reports. They have thousands of appraisal reports that come in every day. They may have an appraisal report on this particular property, a purchase property that was maybe refinanced 6 months or a year ago. So they have an understanding of what that property may be worth, combined with the algorithms they use to test their risk. They have that at their disposal, and they make the decision as to whether they are going to require an appraisal or not. The other dynamic is, you know, borrowers requiring PMI. So we have less than 20% down, and now we're in a market where things are being overbid crazily. And we have private mortgage companies who are actually, you know, they're insuring that difference. And when that difference is maybe an inflated difference, they're taking a second look at that risk. And there may be times when someone who is putting less than 20% down is denied private mortgage insurance because perhaps that private mortgage insurance investor is looking at the appraisal, looking at the purchase price, looking at the overbidding and saying, I don't know if I want to take on this risk. And I'd love to hear from audience members about that actually too. When there are, you know, when you're dealing with buyers who have less than 20% down, there is a risk of whether they will receive private mortgage insurance, especially in an overbid scenario. Okay. I think the next list price strategies impacts highest and best offers. I mean, as brokers, you know, you're setting the prices. And you're setting how the offers are going to be handled. And this is also a factor in some of that bidding and overbidding. And I'd love to hear from the members here about how they do set those prices and how they set the expectation for the buyer and for the seller.
If anybody wants to chime in, Dory, if they want to raise their hand and ask you a question verbally, I can open their audio if you have a discussion. So if you do want any participation, let me know and I can open the audio for anyone that is willing to ask a couple
Uh,
questions.
Steve, is there a reason I can't see the slides anymore?
I think we lost Steve.
We lost it. That's okay.
I can put it, I do have a backup copy here on my desktop that I'm happy to pull up for you if you'd like.
I'm okay. I have something in front of me, but I don't know what the audience is looking at.
They're looking at us.
Okay. So we have consumer reactions to all of this too. So when we talk about COVID-19, and Steve talked about this as well, maybe, you know, there's a consumer who, you know, doesn't want an appraiser to come in the house because of COVID-19. And this can happen in purchase transaction, which is, you know, the audience that we're with today. And it happens also on the refi side. Recognizing this, the federal entities that I talked about earlier, I mean, they put out some what they call flexibilities regarding that appraisal, and you've seen some of that, where maybe an exterior appraisal is done and an interior appraisal is not required, and they're trying to help you know, move business along by doing that. But will be times when maybe there is a consumer who won't let someone in. And if the particular loan or parameters for the loan require an interior inspection, that can become an issue. I've been talking about risk factors all through this. I don't want to belabor that, but just so that everyone understands, it is all about risk. So the players in the mortgage market, when COVID came in, they all reassessing risk. What's going to happen with the economy? What's going to happen with borrowers? Will they be able to make these mortgage payments? Will they have their jobs? Won't they have their jobs? How am I going to verify employment if nobody's there to tell me they're employed? So there's lots of things in the mix here, and it's affecting everybody. You, the broker, we, the lender, the consumer. All of that. And it continues to be uncertain, actually, and ever changing. I think we don't want to belabor that, but I know, Maria, from some emails back and forth, that there was maybe some enlightenment wanted on why or when or what kind of an appraisal is needed. And when the federal entities, when they were trying to help here and give us some flexibility, they gave us some guidelines. And they told us when and when we couldn't have an interior or an exterior inspection. Part of those guidelines also include, on the borrower side, which is not on the screen, loan-to-value ratios, whether the property is owner-occupied, investment, or second home. So they put a bunch of guidelines together to try to alleviate some of that. Most of the majority of purchase transactions, if they're conventional type loans, if the loan-to-values are within guidelines, and Fannie and Freddie Mac will loan up to 97% on a home owner-occupied loan, up to 85% actually on an investment or a second home. So, you know, as a lender, we have to look at, you know, what the guidelines are for qualifying the buyer on the credit side, and then we have to look at the guidelines for the appraisal. So for most purchases, they do allow what we call a desktop inspection, which is basically an inspection done from the desk. So if there's MLS information and lots of photos, the appraiser is able to, if the appraiser is able to put together a credible assignment of the property, they will perform it that way. We also have the option of what we call an exterior inspection, where the appraiser actually does go to the property and take some photos of the outside, but actually does the same thing as the desktop, which is, you know, an analysis based on information they may have from third party or, you know, from MLS. So that's why you probably have appraisers calling you quite a bit. Can you tell me something about the house that I don't see in the MLS or that I don't see in the photos? The appraiser has a job of making a reasonable reliance on the data. And in order to do that, he's likely going to question you and get a comfort level about that information. If they feel they're not getting the comfort level, or maybe there's something else, a property they really need to see, they'll let us know and they'll say, you know, I really can't give you a credible report this way. I need to go in. And this is where you might see that change from, oh, I could do it outside. Oh, no, I can't. Now I have to come in. There are also instances where perhaps we thought we were getting an appraisal waiver, and then as the loan starts to process, we lose the waiver. And there are various reasons for that happening. And some of them are technologically related, and things to do with the systems themselves. And then all of a sudden, as a broker, you hear, oh, I didn't need one, and oh, now I do. So I know you've probably run into that. And these are like inevitable actions from this whole COVID-19 and all this flexibility kind of thing. And as a lender, sometimes we don't know where we're going to sell this loan. We think we may sell it here, but we may end up selling it here. And if we shift gears, that lender may have a different appraisal requirement. And then we may say, okay, I need one now. So you're going to see things like that happening as well. I don't want to spend too much time on this. We'll go right over to what's probably of most interest to you. When we have a borrower who maybe is concerned about his appraisal and says, I'm concerned, I have some questions. Well, the federal or regulatory agencies have guidelines for us when that does happen. So they tell us that we may exchange information with the appraiser when it comes to the physical properties of the appraisal. So contracts, construction plans, environmental reports, Title V's, condo questionnaires, well water results, anything to do with the physicalities of the property, we want the appraiser to know so that they can perform an accurate assignment. In the event, as I spoke to before, where a borrower is maybe questioning something in the appraisal, we can do the following things. We may correct any factual errors. Perhaps the borrower says, there are 3 bathrooms here and the appraiser only has 2. Well, did the appraiser miss a bathroom? It's possible. We may have to send them back out and look. That's a factual error, physical factual error. Does the borrower think that there are other comparable properties in the neighborhood that were missed? That is something we can ask the appraiser to consider. And we can ask the appraiser to provide any other additional or supporting information in their analysis that brought them to the evaluation that maybe we need something clarified, maybe we need something better understood. So those are the guidelines we have as a lender with our regulators and those that are, buying these loans. And also there's that level of independence, which is not in the screed, which is, a given. This, I think, now brings us, Steve, to some more of the Q&A and maybe digging into some specifics.
Yeah, I think this would be a great time if people have questions to start posting them to the Q&A panel. And by the way, I apologize. I'm up here in Maine and apparently my internet didn't like me for 5 minutes. So you lost me. And Dory, thank you for carrying on.
Well, that happens to me with you sometimes too, Steve. So
okay.
Yeah.
Well, hopefully it'll stay with me now for the rest of the morning. So Maria was good enough to send us along some of the initial comments she received from her members to help us in planning this. And I thought maybe we could, Dory, go through this, and then, like I said, we'll take a look at the Q&As that might come in. Let's go back to appraisal waivers for a second, because I don't know if the point that I was starting to make on appraisal waivers came through, because that was right at the time that my internet stopped working, and hopefully it's not a curse. On an appraisal waiver, once the lender has received approval to move forward without an appraisal, isn't that still presented to the borrowers as an option, and that the borrowers might still be able to choose to get a full appraisal done?
Yes, good point. I missed that, Steve. Yes. The borrower has the option of accepting the waiver or requesting a full interior inspection. Yes.
Yeah.
So you may see that happening. So if borrowers are overbidding on a property, they may want an appraisal, or they're comfortable with what they bid, and they will accept that waiver. Yes.
So let's take that and just talk for a minute about the market. Okay, we all know how just really hot the suburban market is right now. That there's a limit on inventory, that I think most properties are selling quickly, and they're probably selling with multiple offers coming in. You've already talked a little bit about the support and the analysis that has to go into the appreciation, but talk just a little bit more about the appraisal process and what you're expecting your appraisers to do when they've got a property that's selling maybe quite a bit over asking, and the comps just aren't there. You know, are there ways that you can work with your appraisers around that situation?
Sure. So we actually, and like most lenders, we do require the appraiser to review the sales contract. We require the appraiser to review the terms, arm's length versus non-arm's length. We require some history on the listing, days on market. We want some insight as to what's going on. So we do want to know that there were, 10 offers. We do want to know that maybe 7 of those offers were between 5 and 525, and 3 of those offers were between 540 and 560. We do want to know what the mindset of the buying pool is out there. We do want to know whether, excuse my language, whether we have a rogue bidder. So appraisers also need to wrap their heads around the reliability of some of the information. So when they're talking to brokers, there's got to be a reasonable reliance that there were 7 offers, that the bids were here and here, or there were 3 offers and the bids were here and here. You may have an appraiser ask you for evidence of that. The onus is on the appraiser to prove and tell us in a credible way what's really happening in the marketplace. And we expect that, especially in an overbidding situation. We want as much insight as we can into what's happening in the marketplace. The appraiser may also study list price changes over time to look at changes in appreciation. They may look at sold price changes over time. There are lots of analysis that the appraiser can do when they're coming up with appreciation. But it's also tempered with a reliability and the credibility of what's happening in the marketplace, and whether the appraiser think that this is a preponderance of evidence. I mean, there's a sufficient preponderance of evidence of this appreciation, or is this a one-time, unusual, very high bid on a property. It's a difficult time to be appraising in. It's a difficult time for brokers. It's a difficult time for lenders because of the risk. And to actually feel like they're comfortable or have enough credible evidence to support, what's happening in the marketplace and take a risk.
Okay, so
Does that help you, Steve?
yeah, it does. Hopefully, it helps the audience more than me. It's the thing that I think that I've learned over the years is that appraising is neither an art or a science, but it's both.
It is both, yeah.
And that the appraiser is giving an opinion of value, and 2 appraisers could come up with different opinions of value on the same property, and so it's sometimes an interesting situation out there.
And the other thing, I'm sorry, Steve, to interrupt, but if I could go back to the point that was made on the first screen,
Mhm.
So if I'm taking the loan in and I'm selling it out, and the content and the federal entity guide says, you know, the weight has to be on the closed sales.
Mhm.
That's a constraint.
Dory,
The analysis goes into what's happening currently and under agreement, and then the onus is upon the appraiser to prove the appreciation if they're adding one to the sales comps in the grid, the sold comps. If they're adding an appreciation factor for that, they better have some darn good basis for it.
yeah.
And very
Okay.
reliable, very evidentiary,
Okay.
something that I can believe.
Okay. So we've had a couple of questions, you know, to come in. This and the last one that just came in is somewhat related to this whole discussion. Um, and Dory, I don't want to put you always on the spot of your lender position. Is I really want to draw on your experience as a certified residential appraiser too.
Well, I knew I would be, Steve. I have a cold pack under my seat.
Okay, good enough. So here's a question for you, and it kind of ties into what we're talking about. Are
Sure.
appraisers scared or nervous or leery to value a home at a price higher than the offer? And I guess it would probably be at a price higher than the asking price. Do you think that appraisers are
This,
nervous about that?
you know, appraisers are in business. They're in business. They have a business. Lender, I have a business. Steve, you have a business. We're all in business. So it is a business risk. So the appraiser has to consider what those risks are. He has a use PAP requirement, an appraisal principle requirement to provide something that's very credible
Hmm.
and reliable. That's a license risk. I have a lending requirement that the content meets the guideline overlay in the appraisal.
Hmm.
So yes, the risk is higher, and they have to assess what that is in their business, and in their, you know, the comfort level of their analysis.
Okay, so we have a
Not easy to appraise, and it's not easy to appraise in marketplaces that are increasing and in marketplaces that are declining. There's an added level of unsuredness
mhm.
because there isn't a preponderance, not always a preponderance of evidence.
Okay, so um, we 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 touched on this briefly earlier, but one of the members of NEAR just posted that, you know, lately he's had several deals where the appraisers are just showing up unannounced, and he's curious whether or not other agents are seeing that, and he's also seeing some lack of communication between appraisers and the lenders. Um, you know, I think we talked a little bit about how when the loan starts through the pipeline and being processed, that the appraisal assignment could change. That it could go from being a desktop to an exterior only, or it could go in a different direction, or it just might be that it's a desktop and an exterior only, and the appraiser knows that all he has to do is go drive out, takes, you know, he wants to go out and take a look at the house as part of that assignment, take some pictures, and then doesn't have to really go inside at all. Would you say that that might be kind of those kind of occasions when the appraisers just show up unannounced?
Well, actually, we from our business model,
Right.
we require the appraiser to let the property contact know what's happening. So if we're not requiring an interior inspection, we will ask the appraiser to contact the whoever the property contact is in a purchase. Could be the broker, could be a private sale, it could be whoever that is, letting
Mhm.
them know that I don't have to come inside, but I will be outside, and I'm going to take some photos, and I'm going to measure the house, and I don't want you to, I want you to know that I will be there at a certain day at a certain time. So we do require that, Steve.
Mhm.
Um, and communication during COVID has become even more crucial than it has in other times, because at the last moment, we may have a borrower who says, I don't know if I want to let them in. The
Yeah.
appraiser could be there. The appraiser could be en route there. The broker could be en route there. And then all of a sudden everything changes. So yeah, the dynamics are different, but we do ask our appraisers, no matter what kind of assignment we're sending them,
Mhm.
to pre-warn. And we also will let the borrower know what kind of an assignment we are doing. But in a purchase, you see, they're not at the property, so it's the homeowner or it's the broker, unless it's a private sale. And a refi, it's a whole different story. And actually, when we do set up the loan, we actually are, being as detailed as we can in knowing what we're going to order and sticking with what we're going to order in this COVID situation. So we've done measures here at the bank to preempt that kind of disruption and to increase communication. And I'm not familiar with what other lenders are doing, but certainly you should reach out, because if you are seeing that, you should reach out. I'm sure the lender would want to know that there's some confusion out there. That's we don't want that. We want to we want the transactions to to go smoothly all around.
I heard that on more than one occasion. You can see in the real life specific situations. That was one instance that we heard as well from one of our members, in addition to the one just posted in the Q&A. So the members would be best to contact the lender to let them know that they're not communicating the visits.
Most definitely, Maria.
Yes.
I mean, there's no reason in the world why either the lenders, the brokers, or the borrowers should not be communicating back to the lender about, something like that.
As brokers, you're talking to one another. So if you're the listing agent and you've got the selling agent, and then you've got, I have the borrower here, the selling agent, the borrower, hey, borrower, is an appraisal needed here? Is an appraisal coming? What's happening? There is that communication can happen. Sometimes it's just, the selling agent to the borrower, to the lender, lender to the borrower, and the selling agent. So it should be able to happen. We try to preempt it as much as we can. Yeah.
One thing I will add is that there's all kinds of different lenders out there. There are the more local community-based banks like Leader. Then there's the national lenders out there. Some that use appraisal management companies. A lot of them now use appraisal management companies who are in between the lender and the appraiser. And so often the lender might not know what the appraisal management company has asked the appraiser to do. So there can often be a disconnect there. And so you might think you're talking to bank A and the lender, and that's going to get directly transmitted to the appraiser. But more times than not, that's going through some sort of an appraisal management company. And a lot of those appraisal management companies are national. Some of them are actually owned by the lender. So there's all kinds of different influences that can come into play there when it comes particularly to communication between appraisers, lenders, borrowers, brokers, etc.
That's a good point, Steve. Yes.
Dory, I think one of the things that we often hear is, why wasn't this house used as a comp? Maybe you can talk for a second about, really, from your perspective as an appraiser, what makes a good comp, and then we're going to talk a little bit about some of the factors that you might have to adjust for. Okay,
Sure.
But let's start first with what makes a good comp.
One that's the most substitutable to the subject. So appraisers look for like substitutes. So if you've got a 6-room, 3-bedroom, 1-bath ranch, the appraiser wants to find 6-room, 3-bedroom, 1-bath ranches to compare it to, because an appraiser is looking for the perfect substitute. Of course, they're not always a perfect substitute, but there are reasonable facsimiles. As brokers, you know that because you do CMAs, so you're kind of doing the same thing. I think there is a misconception out there that the appraiser can only use comps within a mile or uh, some kind of constraint like that, or appraiser can only use comps that are 6 months old. That's a common misconception. So what the appraiser should be looking for is, like I'm saying, is the most substitutable comp. The most substitutable comp may be a year old, maybe 2 years old, maybe 3 days old. But we should be looking for the most substitutable sale. And then we'll be making adjustments based on any time impacts. Sometimes there are maybe not comps in an immediate neighborhood, but perhaps there's a perfect home just like the subject in another neighborhood. And it would be up to the appraiser to figure out whether that neighborhood has the same dynamics that the other home neighborhood has. Maybe it's a great house in that it's the same, but maybe the neighborhood is a little bit different. So it behooves the appraiser to adjust for any neighborhood influence differences if they've got a very substitutable physical property. So appraisers should do this, and they do this in their analysis. I think it's a common misconception that you can only use comps that are 6 months old or only a mile away. It's a very common misconception.
Okay, so Dory, let's now talk about some factors. For example, you know, when you may have a difference, you know, you pulled up your list of comps. You find that perhaps there's a difference in number of bedrooms, or maybe there's some other influence, like maybe waterfront,
Sure.
you know, and so forth. Do you, you know, as an appraiser, how do you factor those kind of differences into your assignment and your assignment results?
Well, we'll go back to you. Of course, you're looking for substitutable sales. So you're looking for the most like, and then you're adjusting for differences. And you're going to pool a lot of this data. And perhaps in the business, they call it a matched pair analysis. In other words, you've got a 6-room, 3-bedroom, 1-bath ranch, and you've got a 6-room, 3-bedroom, 2-bath ranch. One sold for $500, one sold for $505. The difference is $5,000. Is that the bath? Quite possibly. Then you keep doing this with more sets of sales until you have reliable indicators for differences in baths, for differences in bedrooms, for differences in locations, for differences in waterfront. This is a very simplistic way of explaining this to you, but there are regression analyses that are used with large pools of sales. There are, you know, tax assessments and land and depreciation and condition and depreciation kind of analysis that can be done between sales. So the appraisers are tasked with pooling all this information and extracting those impacts, and there are lots of tools available to them to do that. That's kind of a simplistic way of explaining it to you, but that's what happens. They may also survey broker. They may have a particular or an unusual feature about a property, and they may survey 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 brokers in a geographic area. Say, hey, this house has an indoor pool. I'm having difficulty finding sales with indoor pools or extracting, you know, a value for that. So give me some insight. So they may use some insight from brokers. They'll say, I pooled 10. This is what I have. I went to a different town. I found an in-ground pool. I went to this town. I talked to the tax assessor, and I have come up with what I think is a credible, reliable way of looking at the impact of this in-ground pool in the house, not outside the house. That's a very unusual one and a very difficult one.
So Dory, a question that we all get frequently has to do with basements in gross living area. And I want to make just one little editorial comment here when we start to talk about gross living area.
Okay.
there are some towns that include things in gross living area that really are part of the gross building area, and that the appraiser can't consider. And so I'll give a quick example. My son bought a house down on the south of Boston, and the public records indicated that the house had about 2,100 square feet. But when the appraiser came out and did the assignment, it turned out that he had probably around 1,700 gross living area of 1,700 square feet.
Yeah.
So the gross living area is an important calculation, and again, public records don't always accurately compare to what the appraiser has to do, because the appraisers are generally calculating gross living area based off an ANSI standard, and it's pretty specific. But
Yeah.
basements is one area that oftentimes can create some issues. So Dory,
It can.
here's a question for you.
Uh-oh.
How much must a basement be above ground level before it's considered living square feet?
100%, and I'm going to explain why. So this is an overlay. So when I talk about the mortgage marketplace that buy loans, there's an overlay. If there is 1 square foot of below living finished area, all of that finished area, whether it's below or above, has to be excluded from above living area. So that's the rule. So if you've got, a contemporary home and the front of the house is maybe, below grade, but the back of the house, because of the slope, is above grade, any part of that area is below grade. It all has to be considered below grade on the appraiser's grid. Now, that's not to say there could be an exception. So what the regulations also say is if you have a unique property and your analysis or the market reaction to the property is that the layout is such that the form, fit, and function should be included all as one, then you have to prove that and prove it with sales that have similar form, fit, or function. And you're going to deviate from that, removing basement living area from above grade living area. But again, that deviation requires quite a bit of analysis and quite a bit of credibility.
Okay. So we have a question here. If you have a 4-unit condo complex and there's a unit that sold 2 years ago, would you use that unit as a comp, and how would you adjust for appreciation or time?
Sure, if the appraiser felt that that comp was, like I talked about before, extremely substitutable, say a 4-apartment unit, Steve?
4 units, yeah.
Yeah,
In
4
the condo.
units. So if they felt that was very, very substitutable and very, very telling, yes.
Okay.
And they would make whatever adjustments they felt were warranted, whether it's time appreciation or not knowing anything about the property. I can't tell you specifics, but yes, I mean, sometimes an older sale, 1 or 2 or 3 years old, can be more telling when there are no sales in the immediate neighborhood, because there's historical analysis that can be done. So maybe 4 years ago, there were 3 or 4 of these same kinds of properties in that neighborhood, all selling at a certain range.
Mm-hmm.
And other properties, a little bit different, selling at a different price range. And you can extract what that is. Historically, that that's what happens in that neighborhood, or historically, that compared to anything else in that time period, things were selling above or below. So yes, can be very telling.
Okay. So Kim asked a question or made an observation, and I guess I'd like to just sort of respond to this by saying that, without looking at the specific appraisal and the analysis that the appraiser did, kind of giving you an answer is difficult. But her observation was, I just had an appraiser say he can only use homes within 1.5 miles, and he used or she used, or they used a 3,000 square foot split level that sold more than 6 months ago and $71,000 more than the subject. There's a 3-bedroom, 1-bath ranch and 1,800 square feet. There were 2 perfect comps within 2 miles and 2 months for sale date. The appraiser will not consider the 2 comps. You know, again,
Again, a common misconception about that constraint.
yeah.
But I will say this. You know, you talked about AMCs, Steve. And I have heard that, you know, sometimes they will say, hey, you know, could you make sure you find us some sales that are like within a mile or whatever, or, you know, there may be some added content that they're looking at, but again, that's a risk parameter for them. So they're asking, you know, please at least give me something in the mile so that I, you know, because it's a risk or a comfort level, but it's a common misconception that they have to stay within a certain radius, because certainly if another property in another neighborhood is comparable and the neighborhood is comparable, it's the same dynamics as another particular neighborhood, and you can prove that, then it becomes a very viable sale.
Yeah. And again, you know, without looking at the specific circumstances, and
yes, I can't speak to it either, but yeah.
It's hard to ask the appraiser, why did you choose these sales rather than those sales for the basis of your report? But again, I would say that that's a situation where you've got to go back to the lender. I'm assuming, Kim, that you probably already did that if the appraiser is still saying that won't consider the 2 additional comps. And, you know, perhaps there's, and this is the point where we should perhaps even, Dory, just talk for a second about confidentiality. You know, within the uniform standards of professional appraisal practice, appraisers are bound by a confidentiality rule. And that confidentiality rule means that they can really only talk to their client about the appraisal. And the clients are always the lender, maybe the AMC, but it's always the lender. And so, you know, Kim, you might want to call and talk to the appraiser. The borrowers may want to, you know, talk to the appraiser, but the appraiser bound by this confidentiality rule, and it can frustrate people. But that's why, you know, you may find that sometimes communication between the appraiser and different parties gets stymied is because of that rule. Did I describe that well, Dory?
You did perfectly.
Okay.
You know, appraisers and brokers, you're going to interact. We want the appraiser to get, you know, as much detailed information as they can. So, you know, brokers' assistance on that end. You know, physicalities of the property, offers, anything that the broker can grab insight to. It's up to broker to verify and make reliable. Each of you are to remain independent in this process, but there is an exchange of information that's vital to understanding the property and understanding the terms of the agreement. Appraisers will, you know, if appraisers will use common sense, and if you're talking about the physicalities of a property, they will likely engage you. If you're talking about things that are not physicalities of the property, they're going to route you to, independence and confidentiality. And at that point, they will let us know, and, you know, we'll contact the borrower. But, you know, generally, you know, we will see a request for something from the borrower. I mean, it comes from the borrower.
Yeah.
Borrower say, you know, I don't understand this in the report, or, you know, there was a sale around the corner. Why wasn't that used? So, and generally, that request does come in from the borrower.
Okay, so Ann would like to know, am I wrong in understanding or thinking that if a lender is going to be the servicer of the loan, that the appraisal may be factored differently than a loan that will be sold to an investor. So do you have
No,
different appraisal standards?
no,
Yeah,
no,
I don't see that too often either. I mean,
no.
um, you know, it's collateral,
It's
you know,
collateral.
for a loan
Exactly.
decision, and
Yeah.
whether it's being kept as a portfolio loan or whatever. And keeping it as a servicer doesn't mean that you're not selling the loan. Okay, so you can retain the servicing but still sell the loan to Fannie Mae, Freddie Mac, or to someone else.
Correct.
And so you have to kind of abide by their underwriting standards as well. Okay,
Correct.
looking for some more questions, but hopefully there's a few more out there.
It looks like Kim had a follow-up too, and I'm finding that there's a little bit of discrepancy because I heard from one of our directors that was told that they couldn't go out of a certain radius. And it looks like the appraiser that Kim worked with said that they had to stay within that radius. Is that dictated, Dorianne? You were saying that some of the AMCs said that that's their comfort level?
It's possible. I can't talk to, there are overlay requirements from different investors.
Mhm.
Okay.
But if you look at Fannie Mae or Freddie Mac guidance, there are no such constraints.
Gotcha.
Okay?
Okay, I think I missed a question. Yes, I did. Okay. Let me just give me a second just to read this story. If you have something else you want to say for a second, this is a long question and I want to make sure that I get it all right. So here we go. Can you please address why the ask price on a property should have impact on the appraiser's ultimate determination of value? So that's a question, but here goes a little. Sometimes agents will advise sellers to energy price. That's a new phrase for me. I've heard restrained pricing before, but I think it's the same thing, in order to stimulate multiple offers and overbids. Could this strategy potentially result in an appraiser not coming in at the contract price? Would the better option be to overprice so the appraiser doesn't see an overbid? Potentially the ultimate sale price could be the same, but perhaps result in a longer days on market and perhaps no multiple offers. Shouldn't the appraisal be based solely on market conditions and comps and not what the seller's agent strategy is? Okay, so maybe we go to this last part of this question first, okay? Shouldn't an appraisal be based solely on market conditions and comps and not on whatever pricing strategy was used by the sellers and the agents?
Are you looking for me to answer that, Steve?
I think to a degree we already have. Is that as you talked about, the appraiser has to look at sold properties to work to develop an opinion of value, and whatever pricing strategy was employed, whether it was I love this energy price. Okay, thank you for giving me that phrase. I love it. In
And
order
what
to stimulate.
energy price? What are they really saying?
I'm saying I'm interpreting that to be the same as what I've heard in Cambridge, which is restrained pricing,
Oh,
which is
restrained. Okay.
pricing, kind of conservatively, solely to stimulate multiple bids and multiple offers that get over asking. Okay, versus, for example, perhaps coming in, at whatever your CMA said would be, the best price you could expect or whatever. So, but we've already talked about comps and comp selection. And so I would think that, from your experience as an appraiser and as working for a lender, that you're really looking for the appraiser to support the value through sales, but yet also taking a look at multiple offers on the property, and through pulling MLS data and other things, taking a look at how, are there many other sales that are going, over asking? Those kind of statistics are really important. So
They are very important, yes.
yeah,
And
yeah,
it behooves the appraiser to understand it all.
yeah,
So if you have an energy priced home versus
yeah,
an overpriced home, I don't know what other terminology you're using, but
yeah.
it behooves the appraiser to understand that rationale,
Okay. And Ann
because
had,
those sales
right,
become future comps.
right. So,
So it behooves the appraiser to understand what's happening.
okay, so now, Dory, we're going to move into probably one of the more fascinating areas for appraisers these days, and that's solar.
Okay.
Okay, and by the way, Ann, thank you for confirming that my understanding of energy pricing was correct. Um, is there a, I can kind of answer this, but then we're going to go in and we're going to talk about the valuation of solar panels for a second.
Sure.
So the question is there a requirement for appraisers to have solar training in order to appraise a home with solar panels? And the answer is no. There's no requirement for that. We do have classes. We ran one, actually, MBREA ran one just a couple of weeks ago, but there is no specific requirement for appraisers to have training in the valuation of solar panels. Having said that, Dory, perhaps you can talk a little bit about, for example, how Fannie Mae and Freddie Mac view leased
Yes.
versus owned, and how the appraisers then have to approach,
So yeah, Steve is referring to this, what I call this overlay content in an appraisal. So the government entities have a rule, and they have actually said no value can be added to the sales grid for a home that has leased solar panels, because they're not a permanent, they're not owned. What are they? They're very removable at any point in time, and it's a lease. So they don't allow the appraiser to add any value for that. That is an overlay. If the solar panels are owned, then they do allow some contributory value. So the onus is on the appraisal to figure out what that is. Now, there may be what we call match pair. There may be several homes with solar panels, without solar panels, that they can do some extraction for. There are also things like a net present value analysis. So what is the cost of that solar panel? What did it cost to put them on? You owned it, it cost you 20 grand. Your benefit is X amount a month. How long do you anticipate someone will stay in a home? Is it 10 years? Is it 15 years? What is the future? What is the income stream? And what is the net present value of that stream? And then you analyze, annualize that. So when Steve talks about there are courses on this, there sure are. And and some of them are very involved, in figuring out the actual energy efficiency, the actual energy differences. There are some very complicated analyses that can be performed. But in a very simplistic way, I mean, most appraisers who haven't taken that kind of course will do more of a net present value analysis, or a kind of what is the present value of a future stream over a certain length of time. And they'll temper that too with what they know in the marketplace. And they may talk to 10 brokers that say, hey, you sold a house with solar panels. Did they own it? Yep. You sold a house with them. Okay. Did they pay more because it had solar panels? Can you give me insight on that? Did you think you got more money because that happened? So there's a lot that goes into this. Massachusetts is not really on the forefront of solar panels. We do see them more and more, but states like Vermont actually mandate them. So wherever it's possible, they want you to put solar panels on your house. It's like a government energy, like environmental go, do it. So, I mean, we lend in Vermont, and we see a lot more homes and a lot more analysis and detail and backup for solar analysis in states that have a lot more quantities than we do. It's difficult.
Yeah.
It's not easy here because it's not a really large amount of data.
You know, it's just like any other adjustment for value. The appraiser has to be able to see it in the marketplace.
Yeah.
And, you know, if there's not significant number of comps that the appraiser can look at and determine, gee, this house sold for $5,000 more because it has solar panels on it than an absolutely identical house without solar panels, then it becomes more challenging to put the value there. But I think it also goes back to leased is bad when it comes to value. Owned is good when it comes back to value. So just keep that in mind when you're listing properties and helping sellers and buyers set expectations in terms of how much that solar panel might add into value. Okay, we do have a few more questions here. As of as of recent, we are finding a growing number of off-market sales. And I'm assuming that these might be for sale by owner. And it seems that this trend will continue. Some of these sales can be a determining factor on pending sales and appraisals. As an appraiser, Dory, would you consider sales that I guess didn't go through MLS?
Yes.
To be valid comps?
Sure. If you can verify or rely or have enough information about the sale to utilize it, yes.
One of the areas that I've been hearing more about are sales where the property is actually in a trust or maybe even in an LLC, and that the ownership of that LLC gets transferred, and there's no actual sales price or deed. Okay, and those kind of sales are very hard to quantify.
Very difficult.
And include as comps. Okay, okay, somebody is, Maria, you must be deleting questions on me after we answer them, so that's why my screen keeps popping around on me here.
She's too efficient for us, Steve.
Yeah, no, that's good. It keeps me from going back and asking the same question a second time. You know, we do have time for some more questions. If anybody is out there, we're kind of getting to the end of the questions that have been posed so far. Maria, from your experience, you know, and what you hear from your members, what haven't we talked about so far this morning that you think your members would like to hear? And yes, I'm putting you on the spot.
Yeah, and I'm trying to think of anything that hasn't been covered. I think some of the frustration from our members is just, I think the same that is coming from a lot of different angles, is that expectations are so different, and no one's sure sometimes, especially if you're working with somebody and whether it's the agent, the appraiser, the lender that's not responsive or communicating, then I think it would be, if you're not receiving communications, I think whichever party it is, reach out. Don't wait for somebody to contact you, because it seems like the communication or lack thereof is what's probably causing a lot of frustration on all ends of the transaction. Yeah. And to just not sit there and wait and be frustrated, but to be proactive and making sure that communication is happening, or if, you know, changes are going to be made, and maybe setting that expectation up front, say, I'm available, please reach out anytime, to make sure our communications line is open.
So if we're going to talk about things that are kind of a little frustrating, you know, I'll come back and say, well, what do I hear from my members?
Yeah.
Perhaps one of the more frustrating things is when they call to schedule an appointment and they're told, oh, there's a lockbox and here's the code. I can say this, I'll say this candidly: meet the appraiser and bring with you information. Don't just assume the appraiser knows the neighborhood well, knows the school system well, knows maybe the most recent sales, the sale that just happened yesterday. But meet the appraiser. You know, even in this COVID environment, if you don't want to go inside, which, appraisers don't necessarily want to go inside either. At least meet the appraiser at the property. And the other thing is on your listings, the more information you can put in the listings about any improvements that were done and when they were done. Kitchen was completely remodeled with granite countertops and everything else back in 2015. All of that can go into helping the appraiser make a better assessment of quality and condition. So the more information you can add to your listings that way, the more comprehensive incredible results that the appraiser can come up with.
That's a great point, Steve, because a lot of these purchases are or do qualify if they're conventional loans and meet LTV requirements. They are allowed to be desktop, so there is actually no physical inspection of the property at all.
Yeah.
Not even from the outside. So the more information you can give the appraiser, the better.
Yeah.
Because if the appraiser is sitting at the desk going, "Oh, I'm not sure, jeepers, I think I have to go in," and then we get the call, "I got to go in." So the more information you can provide on those listing sheets or renovations done, or the more the better.
Yeah.
Oh, go ahead.
Oh, I was just going to add one more thing. Just be careful of any improvements that were done without permits.
Oh, yikes.
They can certainly create some problems for buyers, sellers, and etc. And with a lot of the house flipping that's going on and other things, there might be a chance where some of that has taken place, and you really need to set proper expectations with sellers and buyers when that happens. I actually had an appraiser who called me because his daughter was buying a house out in Colorado that had been flipped, and the flipper pulled no permits whatsoever and did electrical, plumbing, etc. And my advice was probably should walk away. But that goes with things like finished basements and so forth. We've got a follow-up question. Is there anything as appraisers you want us to have on hand at the inspection besides the comps we used when deciding on the list price with the seller? And I'm gonna say, I'll give you my 2 cents, and then Dory, you can add in. I would say anything you think would be of help in the appraiser's analysis of the house or the neighborhood or the town. Make sure that the appraiser knows that that the school system is ranked number 6 in the state, or that the that the town has an aggressive budget and plenty of money on hand to be taking care of roads, etc. Whatever information you can provide the appraiser for their analysis could come in handy and be able to help the appraiser take a look at factors that, for example, if you take West Roxbury, okay, West Roxbury is part of Boston, but what part of West Roxbury is also part of Chestnut Hill. And so that zip code difference between the Chestnut Hill zip code and the Boston zip code, even though the property is still physically and legally in Boston, can make a significant impact on the value of that house. If you move the house in West Roxbury, a quarter of a mile into Chestnut Hill, all of a sudden the value might be 25% higher. Well, that's the kind of information, maybe not as extreme in a lot of communities, but that I think an appraiser would enjoy receiving. Dory, what else do you think an appraiser should get?
I think you handled it pretty well, Steve.
Well, thank you.
Yeah, definitely. I mean, any knowledge that you have about the property, about surrounding properties, about potential development around the area, employers, any information that you have the appraiser will absorb that.
Yeah.
And of course, it's up to the appraiser to verify it and make sure it's reliable. But yes, all of those things.
Okay. Maria, I think I cut you off a second ago.
I was, well, there was two things now, because I was thinking, we've got a lot of folks, and I see a lot of, in my neighborhood, deliveries by Home Depot and Lowe's going through. So that's a really good point to be aware of all those DIY things that might be going on without permits because people are home and doing all the projects that they never have time
Maybe,
for.
let me add a little bit of added layer to that permit thing that this comes up. And so the federal regulators have that added content rule that says if there is a health or safety issue or violation, they have to be corrected. So this comes into play when we, come across homes that don't have the proper permits. It comes into play when someone has created an in-law apartment without proper permitting. But the risk for the lender and the risk for it being sold is if it rises to a health and safety issue. And that is when the appraiser has to put up the red flag.
Okay. Maria, I just got a notice that somebody raised her hand. I don't know if that means that she'd like to ask a question verbally.
I think she already did. That was Diane Sked, and she had put it in the Q&A.
And at this point, I'm not so sure what you can see because I've just lost that PowerPoint slide that's been up for a while. Do you still see that, or do you now see my regular desktop?
We see your desktop. You just need to stop your screen
Why
share.
don't I stop sharing for a while? Okay, there we go.
I had one last question for Dory because I have heard this come up a few times. Would
I have to go. Yeah.
I'm right behind you.
This one is
I think that's my doorbell. What?
This is probably an easy one. We've had some folks that have worked with an appraiser who requested that a seller walk them around and do almost like a virtual tour via FaceTime. Is that something recommended, or what are your thoughts on those type of?
So again, this is one of those areas of confidentiality and availability of information and how secure that information is. So lenders have, have policies on, what they will do or they won't do, or what they may ask a borrower to do or not do. Now, a borrower may not be comfortable with that. Who controls that now when it's gone? Because that's now in the airwaves, it's on a video, where is that? So security becomes a question when that comes up.
Okay,
And,
so we did get one more question here, and it has to do on mini split heating and air conditioning. If they are in every room, are they considered a primary heating source? And how should the MLS sheet list for number of heating and cooling zones? Well, that part I'll leave up to Maria to answer because I'm not an expert on the MLS listing sheet. Do you list every room with a unit as a zone? Thank you. Dory, would you consider a home that has as a sole heating system the mini split heating and air conditioning as a primary heat source?
yes, if the appraiser feels that it heats or cools the house adequately and to a standard that's market accepted, yes.
And by the way, we haven't even gone into FHA, and we don't have enough time to go into FHA, thankfully. But their minimum property requirements for for appraisals are more stringent in some ways than the conventional loan. And I think you should just be prepared for probably a much more rigorous appraisal process when it's an FHA loan, in terms of the appraiser having to perhaps turn on some appliances, make sure that the heating system is functional and safe and adequate and so forth. So that's a whole nother topic for another presentation, which I'm sure Dory would be just as anxious as I would be to do.
I'm getting my calendar out right now.
Okay, I just want to double check, make sure that I haven't missed anything over on this side. Nope, that one looks like pretty much complete. So Maria, unless you've got anything last that has come your way, I think we have answered most of the questions, covered a lot of territory this morning. And I know I'd like to thank you on behalf of MBREA for inviting us to do this.
Can I ask a question?
Sure, go ahead.
Can I ask a quick question? So what is the inventory looking like, and what's the projection? What's the projection? What is the mindset of homeowners out there? Or what is the mindset for selling a property versus holding it? Any insight on that?
I'm hoping we'll have some of our members that are boots on the ground fielding these emotions that are happening. But from what I hear from a lot of our members, there's an inventory shortage. There has been for a very long time. It's a very hot market, as you guys are seeing the escalation clauses and multiple offers and the high bidding. There's a fear factor for sellers still that are afraid of having people in and out of their homes because of COVID, but then there's the bigger fear of not having anywhere to go because the inventory is so low. So it's an interesting time out there. Our members, for the most part that I'm speaking with, are very busy. And the most challenging group, not challenging, the ones that are getting most frustrated are the first-time buyers, because the pricing is just so high, and that they're not able to compete with the multiple offers well above asking. And that's a frustration for the first-time buyers in particular. So that's some of what I'm hearing. I'm not sure what's going to happen. I think everybody is looking for this crystal ball of what's going to happen in the fall, when usually we have a higher influx. You know, our spring and fall markets get busy, but with not knowing what is going to happen with all of the universities. I know that there's been a huge rental impact in Boston with, you know, some of the universities going completely online. So a lot of our Boston agents that focus on rentals in that area are freaking out about that loss of revenue. And then we also just don't know about, you know, the fear factor of some of the buyers of not having a job, because that's still an issue. We've got unemployment, the federal stimulus running out at the end of this month, and there's just so much uncertainty right now that I think it's making it difficult on both ends. And it's hard for any of our members, even at our national association. I'm sure Steve's very familiar with Dr. Lawrence Yun, and he's trying to make his predictions, and it's hard to know at this point. But we're
and it's also tough because we don't see a whole lot of new construction going on. You know, for a lot of the towns, it's fill-in lots and and so forth. Plus, I'm thinking that we've got a whole bunch of homeowners out there who are now almost handcuffed to their low interest rates. And another fear factor could be, well, okay, I sell and maybe I'm lucky enough to find some place to buy, but am I going to be able to get the same low interest rate that I have now, and be able to continue to enjoy that? You know, my office is in Boston. We're seeing right now that traffic has come back only to 45% of pre-COVID traffic in Suffolk County. We're not seeing. We're thinking that a lot of the restaurants that are built around a lunchtime and after work crowd are going to fail, because we don't have a lunchtime crowd. We don't have an after work crowd. We have a company like Log Me In, and this is something that's going to put further stress on the market. Log Me In, which is headquartered in Boston, they have like the GoToMeeting, GoToWebinar products and everything. I think that their CEO just came out and said that no more than 20% of their staff, and I think we're talking like 3,000 people, are going to return to the office. The rest are going to work from home. You know, out in Worcester, Unum, the insurance company, just said that their 400 employees that are headquartered out there are all going to stay at home, and no, and they're going to, and so that's putting a lot of stress too on the market, because we're finding that a lot of people want to get bigger houses to have better workspace and everything. So it's not just the first-time buyers, but it's probably people trying to sell their condo in JP, wanting to move to, you know, Wellesley or Natick and have a yard and 1 or 2 extra rooms. That's really, you know, adding to that whole stress of the marketplace right now. So it's a fascinating time. I know, and I know I'm looking forward to the day where we can get together physically again, and be able to do things safely. But in the meantime, you know, we've just got to make the best we can of the situation we have.
Yeah, it's
So,
interesting you mentioned the bigger houses, because they said there has been a huge group of folks that are moving out of the urban areas into the suburbs, because they're not going to have to return to work, and looking for homes that are bigger to not only accommodate potentially 1 work from home office, but 2 work from home offices, potentially space for kids to be doing their schoolwork from home, because the public schooling situation is still up in the air as well.
yeah. So a lot of stresses on the marketplace right now. Maria, again, I'd like to thank you for letting Dory and I come in and interact with your members.